Okay, let's unpack this. Imagine potentially saving thousands, maybe even tens of thousands of dollars on your student loans.
Mm-hmm.
Or, paying them off years faster than you thought possible.
Right.
Or just finally having that one simple monthly payment instead of like juggling this confusing stack of different bills every month.
It sounds amazing, doesn't it?
It sounds incredibly appealing.
Yeah.
Like a total, absolute no-brainer. But the source material you've shared makes it abundantly clear for a vast number of people, making that move to refinance student loans comes with a really significant and often critical trade-off.
And you've hit on the core tension right there. While the potential upsides, for, lower rates, that beautiful simplicity of one payment, they're definitely real and they're tempting.
Yeah.
But what you might give up, especially if you have federal loans, the ones from the government, those can be incredibly valuable safety nets, protections, and options that you can't get them back.
Right.
It's absolutely not a one-size-fits-all decision, and the sources really, really emphasize the need for a careful, personal calculation.
Absolutely. So today we're taking a deep dive into this stack of articles, research papers, and your notes to explore when refinancing your student loans might truly make financial sense for your specific situation. And perhaps more importantly, we need to shine a bright, unflinching light on the situations where, according to the experts and regulators, it definitely, unequivocally does not make sense.
Our mission today is really to cut through some of the noise and, some of the slick marketing that's out there.
Yeah.
We'll define exactly what refinancing actually means and, just as crucial, how it differs fundamentally from federal loan consolidation. That's a huge point of confusion for so many borrowers.
I can see that.
We'll weigh those significant advantages, the allure you mentioned, against the crucial, sometimes permanent risks. We'll look at who typically qualifies for refinancing and walk through the steps involved if you decide to pursue it.
And critically, we'll delve into some pretty serious potential pitfalls and regulatory concerns that your sources, particularly that CFPB report, highlight findings that reveal some, concerning practices in the private student loan space.
Yeah, that's important context.
We even have a fascinating real-world example from Reddit that perfectly illustrates just how complex this decision can be, even for someone with a very high income and, a strong financial position. It's all about giving you the information to make the most informed choice for your life and your financial future.
Exactly. So let's start at the beginning. What exactly do we mean when we talk about refinancing student loans? And why is it so often confused with federal loan consolidation? Because getting this distinction right is, it's the absolute foundation for everything else we'll discuss.
Great place to start. So according to sources like Sparrow, NerdWallet, Citizens Bank, when you refinance your student loan, or maybe multiple loans, you are essentially taking out one brand new loan. And crucially, it's from a private lender. Think banks, credit unions, or maybe those online lenders.
Right, a private company.
This new private lender then uses the funds from your new loan to pay off your existing student loans, whether those were originally federal, private, or, a mix.
Okay.
Once that happens, your old loans are gone, wiped out. And you now owe money only to this new private lender under their specific terms and conditions.
That's right. And the primary motivation for doing this, as laid out in the material we looked at, is typically to secure a lower interest rate than you currently have.
Right. Save some money.
Exactly. This could be because maybe your credit score has improved dramatically since you first borrowed, or maybe your income is higher and more stable now.
Or maybe the market changed.
Or simply because current market interest rates are lower than they were when you originally took out the loans. The goal is usually to save money on the total cost of the loan over time. You might also refinance to change other terms, like, the length of time you have to repay.
And one of the big appeals, I think, especially if you're managing multiple loans from different years or different schools, is that refinancing rolls all of those existing loans into that single new private loan.
That simplification factor.
Yeah. So instead of multiple payments to potentially multiple servicers each month, you have just one loan, one servicer, and one tidy monthly payment. Laurel Road, Citizens Bank, Sparrow, they all highlight this.
Now, here is the absolutely pivotal point. The one that cannot be stressed enough, okay? And it's highlighted across virtually all the sources, including NerdWallet, Citizens Bank, and the CFPB. You can only refinance student loans with a private lender.
Only private. Got it.
And this is the critical part. Once you refinance federal government loans with a private lender, they are permanently converted into private loans. That change is irreversible.
Wow. Okay. Permanent.
You cannot refinance them back into federal loans later on, no matter what happens. That door closes the moment the private lender pays off your federal debt. It's gone.
That permanence.
Yeah,
That's really the core of the trade-off we mentioned right at the start, isn't it?
absolutely.
Because federal loans come with a whole suite of benefits, protections, potential safety nets,
Yeah.
things that private loans simply do not offer, or maybe they offer something similar, but it's usually much more limited, less standardized.
That's exactly it. And we're going to dive deep into what you lose in just a moment. But first, let's clear up that other term people often hear, federal loan consolidation, because it's completely different from refinancing.
Right. Good idea. People mix those up.
They do. Federal loan consolidation is a process where you combine existing federal student loans into a single new federal loan. This is done exclusively through the U.S. Department of Education, not a private company.
Okay, so federal stays federal.
Precisely.
And the main reason people do this, is it just simplification again?
Simplification, primarily, yeah.
Yeah.
You get one monthly payment to the federal government instead of potentially several. Sources like Citizens Bank and NerdWallet point this out.
Makes sense.
It can also sometimes help you access certain federal income-driven repayment plans or maybe qualify for public service loan forgiveness if you have older types of federal loans like FFEL loans that wouldn't otherwise qualify. By consolidating them into what's called a direct consolidation loan, you might open up those options.
Okay, so strategic reasons sometimes too.
Sometimes, yes. But unlike refinancing with a private lender, federal consolidation is generally not a path to a lower interest rate.
Oh, okay, that's a big difference.
Huge. The interest rate on your new direct consolidation loan is calculated as a weighted average of the interest rates of the federal loans you're consolidating. And then, get this, that average is rounded up to the nearest 1/8 of a percentage point.
Rounded up, not down.
Up. So you'll likely end up with a rate that's very similar, maybe even slightly higher than your current average rate. It won't save you money on interest in the way private refinancing potentially could.
Gotcha. So consolidation is about simplicity or program access, not rate reduction?
Exactly. And the most important difference, the reason it's not the same as refinancing. Federal consolidation keeps your loans federal. You absolutely retain all those valuable federal benefits and protections that you would give up by refinancing with a private company. Citizens Bank and NerdWallet are crystal clear on this distinction.
Okay.
So the big takeaway here, right? The foundational knowledge for this entire deep dive. Private refinancing means potentially a lower rate and one payment, but you lose federal benefits forever. Federal consolidation means one payment, you keep federal benefits, but your interest rate probably won't go down, might even nudge up slightly.
Understanding that core difference is step one.
It's absolutely step one in figuring out if refinancing is right for you.
Okay, with that crucial distinction made, let's pivot to the tempting side, the allure we talked about. Why do people even consider this, knowing the risks involved, especially with federal loans? What are the potential upsides of refinancing?
Well, the number one driver, the big potential win, is almost always the chance to secure a lower interest rate.
Right, the money.
It usually comes down to the money. As Sparrow explains, if your financial picture has brightened considerably since you first took out your loans, maybe your credit score has soared, like you went from a 650 to a 780, or you've landed a much higher paying job with stable income, you might be seen as a much less risky borrower by these private lenders.
And you might get rewarded for that improvement.
Exactly. You might qualify for a better rate. And economic conditions play a massive role here, too. Sparrow specifically notes that when the Federal Reserve cuts benchmark interest rates, it often leads to lower interest rates on private loans, including refinanced student loans.
So timing matters.
Timing can matter a lot. So someone who borrowed at a high rate during one economic period might find much lower rates available in another. Think back to that Reddit example you provided. The borrower has a 7.25% federal rate.
Yeah, it's pretty high.
It is. In some market conditions, qualifying for a significantly lower private rate, maybe 5% or even lower, would be, mathematically speaking, a no-brainer on the surface, even considering the lost benefits. And a lower interest rate isn't just a nice number, it directly reduces the total amount of interest you pay over the entire life of the loan. As Laurel Road points out, this can free up thousands, potentially tens of thousands of dollars that would have otherwise gone just to interest.
That's money you could use for other goals, or just pay the loan off faster.
Exactly. Either pay off the loan faster or simply keep that money. That's a powerful incentive for people.
Saving thousands definitely gets people's attention.
Yeah.
Beyond the money aspect, the simplification we touched on that seems like a really huge draw too.
Oh, definitely.
Juggling multiple loan accounts with maybe different servicers, varying due dates, sometimes different payment amounts, it can be incredibly stressful.
It's a mental load.
Yeah. Consolidating everything into one new loan with one payment to a single servicer just makes debt management significantly easier. And it can help you avoid those dreaded late or missed payments that can, ding your credit score.
Right. This point is consistently made by Laurel Road, Citizens Bank, Sparrow, that simplification is a major plus for many borrowers.
Another key appeal seems to be the ability to adjust your repayment terms to better suit your current goals.
That's right. With a new private loan, you often have the flexibility to choose a different repayment timeline than your original federal or private loans offered. Laurel Road discusses these options pretty clearly.
So, for example, you could choose to shorten your loan term dramatically.
Yeah,
Maybe you're on a 20-year plan and you refinance into a 5 or 10-year term.
exactly. This strategy is often used by borrowers who maybe got a big raise or just really want to become debt-free as quickly as possible.
Okay.
Now, your monthly payment will likely increase significantly with a shorter term, obviously, but you'll pay off the loan much, much faster and save a substantial amount of interest compared to stretching it out over the longer period.
So higher payment, but less total cost and faster freedom.
Correct. Or, on the flip side, if your main priority right now is reducing your current monthly expenses to maybe free up cash flow for other things like buying a house or starting a family, you might choose to lengthen your repayment term. Perhaps going from a standard 10-year plan to a 15 or even 20-year private refinance loan. This would lower your required minimum monthly payment.
That sounds good. Lower payments. But what's the catch?
The crucial trade-off there, however, is that you will almost certainly pay considerably more in total interest over that longer period. Even if the interest rate itself is lower than your original rate, stretching payments out for more years means more interest accrues overall.
Ah, okay. So it's a calculation, lower monthly payment now versus potentially much higher total cost later.
Exactly. Present cash flow versus total long-term cost. You have to decide what's more important for your situation.
Switching servicers is another practical benefit you mentioned. Let's be frank, experiences with federal loan servicers, especially over the past couple of years with a return to repayment after the pause.
It hasn't always been smooth sailing for everyone, no.
No. So if you're really unhappy with your current servicer, maybe you can't get through, or you feel like you're getting bad information. Refinancing to a private lender automatically means you get a different company managing your loan. NerdWallet points out that this can be a motivation for some borrowers.
It can be. And then there's the cosigner angle, which is quite common, right? Many students need a cosigner, usually a parent or guardian, to qualify for their original loans in the first place, or maybe just to get a better interest rate.
Right, especially for undergrad, maybe.
Often, yeah. So if your own credit and income are now strong enough on their own, refinancing under just your name can release that cosigner from their legal obligation to repay the debt if you can't.
Oh, that's huge for the cosigner.
It can be a massive relief for them. Laurel Road specifically mentions cosigner release as a potential benefit, citing information from lenders like Lenke who offer this feature as part of their refinancing products.
And conversely, what if your credit isn't great right now, but you maybe have a parent or someone willing to help?
Well, conversely, if your own credit isn't quite stellar yet, but you have a creditworthy friend or family member willing to co-sign for you on the refinance application, doing that could help you qualify for the loan when you otherwise wouldn't, or maybe get a significantly better interest rate than you could on your own. Sparrow and Laurel Road both mention using a cosigner to qualify or get a better rate.
Okay, so cosigners can work both ways in refinancing, getting one off or needing one on.
Exactly. And finally, just a smaller point, some private lenders try to sweeten the deal by including unique perks or discounts. These aren't universal, and you need to read the fine print, but...
Like what?
Well, they might include things like access to free financial education resources, career coaching sometimes, or maybe offering a small interest rate reduction, often 0.25%, if you set up automatic payments from a linked checking account with that same institution. Laurel Road, for example, details their linked checking account that offers a potential rate discount like that.
Okay, so a little extra bonuses potentially.
Potentially. You shouldn't choose a lender based only on those, but they can be a small tiebreaker if you're comparing similar offers.
So when you sum it all up, the potential for significant interest savings, the simplicity of one payment, The flexibility in repayment terms, maybe switching servicers, options involving co-signers, potential perks, the allure of refinancing is pretty powerful.
It really is.
It's easy to see why borrowers are drawn to it, especially if they're looking at a high interest rate on their current loans and think, there's got to be a better way.
Absolutely. But, and this is where the deep dive gets really serious, all these potential upsides come with a significant and often very high cost, particularly for those with federal student loans. This is the critical downside that you absolutely positively must understand before making any move.
Okay, let's get into it. The scary part, and the single biggest thing you give up, the one that financial experts and consumer advocates warn about most vehemently, is the permanent loss of access to those valuable government benefits and protections we touched on earlier.
Yeah.
As NerdWallet, Citizens Bank, the CFPB, Laurel Road, basically everyone emphasizes, once you refinance federal loans into a private loan, you lose these. Forever. No going back.
This is not a small thing. It's huge. Foremost among the lost benefits are the income-driven repayment, or IDR, plans.
Okay, IDR. Tell us about those again.
These are the federal programs like SAVE, Saving on a Valuable Education, PayE, Pay As You Earn, IBR, Income-Based Repayment, and ICR, Income Contingent Repayment. They calculate your monthly payment based on your discretionary income and your family size.
So it adjusts to what you can actually afford.
Exactly. It can make payments significantly more affordable, especially for borrowers with high debt relative to their income or whose income might be variable. And crucially, these plans offer potential loan forgiveness of the remaining balance after 20 or 25 years of qualifying payments.
Forgiveness, like the rest just disappears.
Gone. Wiped clean. Or it's 10 years of payments if you qualify under public service loan forgiveness, which uses IDR payments. NerdWallet and Laurel Road explicitly call out the loss of these IDR options and the associated forgiveness as a major drawback of refinancing federal loans.
Wow. Losing IDR seems particularly risky for borrowers whose incomes might fluctuate. Maybe freelancers or people starting a business or who anticipate periods of lower income, or just anyone with a really large loan balance that would be basically impossible to pay off under a standard 10-year plan without severe financial distress.
It's a critical safety net for millions and millions of borrowers. Losing it is a massive risk.
Okay, what else do you lose besides IDR?
Well, beyond IDR, you lose access to federal loan forgiveness programs tied to specific professions or situations. The big one is public service loan forgiveness, PSLF.
Right, PSLF, for people working in public service.
Exactly. If you work full-time for a qualifying employer, think government agencies at any level, 501c, nonprofits, some other nonprofits, you lose eligibility for PSLF if you refinance your federal loans.
And PSLF is...
And powerful, right? Incredibly powerful. It forgives your entire remaining federal loan balance tax-free after you've made 120 qualifying monthly payments, which typically takes 10 years, while working for one of those eligible employers. This can literally wipe out hundreds of thousands of dollars in debt for doctors, lawyers, social workers, government employees.
So if you refinance your federal loans privately,
You disqualify them for PSLF, period, full stop. This is highlighted by NerdWallet, the CFPB, Laurel Road. Everyone agrees. Similarly, teachers who work for 5 consecutive years in a designated low-income school lose eligibility for teacher loan forgiveness if they've refinanced the federal loans they might have gotten forgiven.
those forgiveness programs alone are just massive. For someone who is pursuing PSLF or even thinks they might pursue it someday, refinancing federal loans sounds like an almost universally terrible financial decision, regardless of the potential interest rate savings.
It almost always is. You'd be giving up potentially life-changing debt relief just to get a slightly lower interest rate on a loan you'd still have to pay off entirely by yourself. The math rarely works out in favor of refinancing in that scenario.
Okay, so no IDR, no PSLF or teacher forgiveness. What else is on the chopping block?
You also lose access to the flexible federal payment postponement options, specifically deferment and forbearance.
Right, the options if you run into trouble.
Exactly. These federal programs allow you to pause your payments temporarily if you lose your job, face economic hardship, decide to go back to school, have a medical emergency, things like that.
And private lenders don't offer that.
Well, some private lenders might offer their own hardship options, sometimes called forbearance, but they are typically much less generous than the federal ones. The terms vary wildly from lender to lender, the duration might be much shorter, and crucially, you are almost always responsible for paying the interest that accrues during those pause periods with a private loan.
Ah, so the balance keeps growing even if you're not pitching?
Almost certainly yes. With certain federal deferments, like when you're back in school or sometimes during unemployment deferment for subsidized loans, the government might actually pay the interest for you so your balance doesn't grow. You lose that key potential benefit with private refinancing. NerdWallet and Laurel Road both point out this crucial difference in how interest is handled during postponement.
So let's paint a picture. Imagine losing your job after you've refinanced your federal loans privately. With the original federal loans, you'd likely have robust forbearance or deferment options, maybe even interest subsidies, giving you significant breathing room.
Right.
With the new private loan, you might have very limited options, maybe just a few months of forbearance or perhaps none at all, and the interest is almost certainly piling up the whole time, making your debt burden even worse when you try to restart payments.
That's a very real risk you take on. And finally, you lose access to specific federal loan discharge options. These are the ultimate safety nets if the absolute worst happens.
Discharge meaning the loan goes away entirely.
Yes. Things like discharge due to total and permanent disability, TPD. Or discharge if your school defrauded you or closed abruptly. That's the Borrower Defense to Repayment Program. Or, in the tragic event of the borrower's death, federal loans are typically discharged.
In private loans.
Private lenders' policies on these situations vary significantly. Some might offer TPD discharge, but the definition or process might be stricter than the federal one. Death discharge policies also vary. Some might discharge the debt, others might try to collect from the estate, or even a co-signer. Protections like borrower defense generally don't exist in the same way for private loans. NerdWallet and the CFPB touch on the loss or significant variability of these crucial discharge options.
Okay, let's just recap the biggest cons again, especially for federal loans, because this is critical.
Yeah.
You give up income-driven repayment plans and their potential forgiveness after 20, 25 years.
Yep.
You give up employment-based forgiveness like public service loan forgiveness, 10 years, and teacher loan forgiveness, 5 years. You give up flexible and potentially interest-subsidized payment postponements like deferment and forbearance if you hit hard times.
Right. Much less flexibility there.
And you give up important federal discharge options for things like permanent disability, school fraud, or death.
Correct. You lose that whole federal safety net.
That's a really significant suite of protections to forfeit just for potentially a lower interest rate.
Are there other downsides, maybe beyond losing these specific federal benefits?
Yes, there are a couple more practical hurdles. Even setting aside the federal benefits issue, refinancing with a private lender isn't an option for everyone just because they want it.
Right. You have to qualify. Exactly. Private lenders are businesses, right?
Yeah.
They need to be confident you can actually repay the loan. This means they typically require a good credit score. Sources like Sparrow, NerdWallet, and Laurel Road suggest you'll likely need a FICO score in the mid to high 600s at an absolute bare minimum. But realistically, to get the best interest rates, the ones that make refinancing most attractive, you'll probably need a score much higher than that, likely well into the 700s, maybe even close to 800.
Okay. And income.
And you need stable income. You have to show them, usually through pay stubs or tax returns, that you have enough income relative to your debts, your debt-to-income ratio, to comfortably make the new loan payments.
So if your credit is shaky, maybe you've missed some payments in the past, or your employment history is spotty, or you just don't make a lot of money relative to your debt.
You might not even qualify for refinancing at all. Or you might only qualify for an interest rate that isn't actually much better than what you already have on your federal loans, or in some cases, it could even be worse. That makes the whole exercise pointless, especially given the benefits you'd lose.
Right. And if you don't meet the criteria on your own,
then, as we mentioned earlier, you'll almost certainly need a creditworthy cosigner to vouch for you. While this can be a pro if your goal is specifically to add a cosigner to get a better rate, it becomes a con if you can't qualify a loan and you don't have someone willing and able, financially speaking, to co-sign for you. It can be a barrier.
Okay. Another risk you touched on briefly. Variable rates.
Yes, that's a significant potential risk, especially in certain economic climates. Private lenders often advertise a very low initial interest rate for their variable rate refinance loans, often lower than their fixed rate offers.
Sounds tempting.
It can be very tempting. However, variable rates are tied to a market index like SOFR or Prime, and they can change over time, usually monthly or quarterly, depending on the loan terms. In a rising interest rate environment like we've seen recently, your variable rate could increase significantly over the life of the loan. It might start low, but it could end up much higher than the fixed rate you could have locked in. This could end up costing you far more in total interest. Laurel Road specifically warns about this risk. It's a gamble.
So you might save money initially, but lose big time later if rates climb.
Potentially, yes. You're betting on interest rates staying low or going down, which isn't always a safe bet. A fixed rate gives you certainty about your payment and total cost, even if it starts slightly higher.
And one final, often overlooked detail you mentioned, the grace period.
Right. If your federal loans are currently in their grace period, that typically 6-month window after you leave school before your first payment is officially due refinancing means that grace period usually ends immediately.
Oh.
Repayment on the new private loan would likely begin right away, often within a month or two of the loan being dispersed. This means you'd start making payments potentially months earlier than you would have needed to with your original federal loans. Laurel Road brings this up as something important to factor in if you're a recent grad considering refinancing.
So, okay. There's the appeal, lower rates, simplification, flexibility, and then there's the cost, giving up that powerful federal safety net, the hurdle of needing good credit and income to even qualify, and the potential risks of variable rates or losing your grace period.
It's a lot to weigh.
This brings us squarely to the million-dollar question then. When, after weighing all of this, does refinancing student loans actually make sense? Who is it really right for?
Well, let's start with the easier scenario. The decision is much, much simpler if you only have private student loans right now.
Okay, no federal loans in the mix at all.
Exactly. Since private loans don't come with those federal benefits like IDR, PSLF, or robust federal forbearance options in the first place, you're not giving up any of those crucial safety nets by refinancing them.
Because you never had them.
Because you never had them to begin with. So in that scenario, refinancing your existing private loans with a different private lender simply to get a lower interest rate or maybe better repayment terms. That's often a pretty straightforward financial win. As Sparrow and NerdWallet agree, if you can get a better deal on your private loans and that's all you have, it's usually a good move to investigate.
Okay, that makes sense. But the big question is for people with federal loans, right?
Right. It's when you have federal loans or a mix of federal and private that the decision becomes significantly more complex. It's a real balancing act. According to NerdWallet, and basically the consensus from all the sources we looked at, you should only seriously consider refinancing federal loans if you are absolutely, positively 100% certain that you do not need and will not use any of the federal benefits, protections, or forgiveness programs we spent so much time detailing.
That sounds like a very high bar.
It is, and it should be. This typically means you are likely in a much better financial position now than when you originally took out the loans.
Like what?
You probably have a high, stable income. You have excellent credit. You feel very secure in your job and your overall financial future. Sparrow highlights this improved financial position as a key indicator. You feel extremely confident that you won't need those federal safety nets like IDR if your income suddenly drops, or forbearance if you unexpectedly lose your job, or PSLF because you're definitely working for a non-qualifying employer and have no plans to ever switch back to public service.
Okay, so high income, great credit, job security. What else?
It also generally means you likely have a relatively high interest rate on your existing federal loans. Again, think of that 7.25% rate from the Reddit example we keep mentioning. And you can genuinely qualify for a significantly lower interest rate from a private lender right now.
Significantly lower being the key phrase.
Absolutely. NerdWallet and Sparrow both stress the need for a high existing federal rate and the ability to get a substantially lower private rate. Shaving off just, say, 0.25% or 0.50% might not be worth giving up all those federal protections. The potential savings need to be substantial to justify the risk. And again, remember that the current economic environment with higher baseline rates can make finding those dramatically lower rates harder than it might have been a few years ago when rates were near historic lows.
Good point. The market conditions really matter for that calculation.
They really do.
Yeah.
Another reason might be if your primary motivation is simply to consolidate multiple loans, maybe a mix of federal and private, into one single payment for convenience, and maybe switch servicers because you dislike your current one. But even then, you have to fully understand and consciously accept that losing the federal safety net forever is the price you pay for that convenience and any potential rate saving.
And NerdWallet offered an interesting nuance, didn't they? About not having to refinance everything.
Yes, that's a smart point. You don't necessarily have to refinance all your federal loans if you decide to go private. Let's say you have some high-interest federal loans, like maybe grad PIL U.S. loans taken out for grad school, which often have higher rates, or parent PIL U.S. loans. But you also have some lower interest undergraduate direct subsidized or unsubsidized loans.
Oh.
You could potentially choose to only refinance the high-interest PLUS loans privately to try and get a better rate on that specific debt while strategically keeping the lower-interest direct loans federal.
So a hybrid approach.
Exactly, a targeted or hybrid approach. This allows you to potentially get some interest savings on your most expensive debt while still retaining all the federal protections and benefits on the rest of your federal loans. It acknowledges that maybe the risk-reward calculation is different for different parts of your federal debt.
That's clever. It lets you keep some of the safety net.
It does. It requires a bit more management, as you'd still have a federal servicer and a new private servicer, but it could be a good middle ground for some borrowers who are hesitant to go all in on private refinancing.
This is where that Reddit example you found becomes so illuminating. Let's look closer at that specific scenario because it just perfectly encapsulates this really complex decision, especially for a certain type of high-earning borrower.
It really does. Okay, so we have someone who started with a significant amount of federal student loan debt, around $240,000 initially, carrying that high interest rate of 7.25%. They also had some private loans, but they'd managed to pay those down significantly already.
Okay. And their career path changed.
Dramatically. The borrower apparently started their career in public service, likely with a much lower income. During that time, the interest on their high-balance federal loans probably caused the total amount owed to grow significantly, perhaps even while they were making payments under an income-driven repayment plan. That's common when payments don't cover accruing interest.
Right, negative amortization.
Exactly. But then they transition to a high-paying job in the private sector.
And this is where the situation gets fascinatingly complicated regarding the refinancing question, right? The household income is now extremely high.
Extremely high. The borrower themselves makes $180,000 a year, and their spouse brings in $270,000 plus potentially $120,000 in bonuses. So you're looking at a total household income somewhere north of $550,000 before taxes.
Wow, okay. And they have savings targeted for the loans.
Yes, they mentioned having saved up $60,000 specifically to throw at the federal loans as a lump sum.
Okay, so that high income is the key factor challenging the traditional never refinance federal loans advice here, isn't it?
It's the absolute crux of it. Because their income is now so high, they will almost certainly no longer qualify for affordable payments under any federal IDR plan when they have to recertify their income, which they usually have to do annually.
Their income is too high for the income-driven part to help them anymore.
Precisely. They even mentioned in the post that trying to file taxes separately, which is a common strategy some married couples use to lower the income used for IDR calculations, would actually cost them more in extra taxes than any potential IDR payment reduction would save them.
So that loophole is closed for them too.
Effectively, yes. So they are essentially losing access to the primary benefit of the main federal safety net affordable IDR payments because they are now so financially successful. The safety net isn't designed for households earning over $500,000 a year.
Right. Now, they do mention significant expenses, living in a very high cost of living area, an $8,000 a month mortgage, childcare costs.
True, high income often comes with high expenses in certain locations.
But even with that, a $550,000 plus household income provides substantial capacity for aggressive debt repayment. And the comments on the Reddit thread seem to confirm this, right? Many people suggested they could simply crush that $240K debt very quickly with their current income.
Yeah, the consensus seemed to be that mathematically they could likely pay it off in just a few years if they prioritized it, making the long-term forgiveness aspects of IDR irrelevant for them.
So this scenario forces them to reevaluate the actual value of the remaining federal safety net to them. For someone with this level of income stability and earning potential, the likelihood of needing long-term IDR or extensive forbearance or even qualifying for PSLF, since they're in the private sector, is significantly lower than it would be for a lower-income borrower or someone in a less stable career path.
Exactly. Aggressively paying down that 7.25% debt as fast as possible to minimize the total interest paid over, say, the next 2-4 years becomes a very real, mathematically appealing strategy. In this specific high-income case, the perceived value of keeping the federal safety net might genuinely be less critical than the definite ongoing cost of carrying that high-interest loan that could otherwise be paid off quickly.
However, what's really telling, I think, is that even this borrower, who seems like a prime candidate on paper, is still hesitant about refinancing.
That's the fascinating part.
They specifically noted that even with their excellent financial profile, The current private interest rates they were seeing weren't so low that refinancing felt like a definite slam dunk right now, compared to just focusing all that high income on aggressively paying down the existing federal loan at 7.25%.
Right. Maybe they were seeing private rates around 6% or 6.5%. Low, yes, but maybe not low enough to make the switch feel overwhelmingly compelling given what they'd lose.
Exactly. They are actively weighing the potential, but maybe not massive, interest savings from a slightly lower private rate against giving up the entire remaining federal safety net, however unlikely they think they are to actually need it.
It perfectly illustrates that even when someone checks many of the boxes for whom refinancing might make sense, high income, stable job, high federal rate, losing IDR eligibility anyway, the final decision is still deeply personal. It involves more than just running the numbers.
Yeah, what else are they likely weighing?
Well, things like evaluating job security in their specific field. Even high earners can face layoffs. Considering those high ongoing expenses, what if, heaven forbid, one income source disappeared unexpectedly? Assessing their personal tolerance for risk, how much is that sliver of federal protection worth as insurance? And understanding that the private loan terms, while perhaps having a lower rate now, might be less flexible down the line if unforeseen circumstances arise.
It's a powerful reminder that even for the seemingly ideal candidate, the value of the federal safety net, even if the probability of needing it feels low, is still a real consideration. It's not zero.
Absolutely not. As some sources suggest, asking yourself specific questions, almost like running through a checklist, is crucial for anyone considering this, but especially for federal borrowers.
Like what kind of questions?
Questions like, how truly stable is my job and income stream? What are my other major financial obligations and goals? How likely am I ever realistically going to need income-driven repayment or extended forbearance? Am I eligible for or even remotely considering pursuing any federal forgiveness programs like PSLF? And critically, can I truly qualify for a significantly lower interest rate privately right now, given current market conditions? Answering those honestly is key.
Right. It's about understanding your own risk profile and what that peace of mind, that federal insurance policy is worth to you personally.
Exactly. So if, after all this analysis, after asking those hard questions, you conclude that refinancing is the right strategic move for your specific situation,
Yeah.
how do you actually go about doing it? What's the process?
Okay, let's walk through that. The sources lay out a pretty clear process. First, understand that private lenders have specific eligibility criteria. As Sparrow and Laurel Road point out, they'll look closely at things like your degree type, the specific loans you want to refinance, but primarily they're focused on your credit score and your income. Make sure you likely meet their minimum requirement before you even start shopping around, just to save yourself time.
Good first step. Then what?
Then, and this is absolutely crucial, you must shop around and compare offers from multiple lenders. Don't just go with the first lender you see an ad for or the one your friend used. Rates and terms can vary significantly between lenders, even for the same borrower profile.
Okay, how do you compare without hurting your credit score?
Great question. The best way to start this comparison shopping is by looking for lenders that offer pre-qualification or rate estimates. Reputable private lenders provide this service, and it relies on a soft credit check.
Soft check, meaning it doesn't impact my score.
Correct. A soft inquiry doesn't affect your credit scores at all. It allows you to see the potential interest rates and loan terms you might qualify for with that lender based on the initial information you provide and the soft pull. Both Sparrow and NerdWallet strongly advise starting the process here, getting multiple soft check estimates. Okay, so you get maybe 3, 4, 5 rate estimates using soft checks first.
Exactly. It's vital to understand the difference. That soft check is just an estimate, like browsing prices. A hard credit check, which happens only when you formally submit a complete loan application to a specific lender, does temporarily affect your credit score, usually knocking it down by a few points for a short time. Sparrow explains this distinction very clearly.
So the strategy is, use soft checks with several lenders, maybe online lenders, traditional banks, credit unions, to get a good idea of the range of rates you're eligible for. Then choose the top 2 or 3 lenders that gave you the best potential offers and formally submit complete applications to them. That's when the hard credit check happens.
Okay. And you mentioned something about timing those applications.
Yes, be smart about the timing of those formal applications that trigger the hard checks. Credit scoring models like FICO and VantageScore have rules specifically designed to encourage rate shopping for certain types of loans, including mortgages, auto loans, and yes, student loan refinancing.
How does that work?
They will typically treat multiple hard inquiries for the same type of loan if they occur within a specific short time window as just a single inquiry for scoring purposes. This minimizes the negative impact on your credit score from shopping around.
Ah, okay. What's the window?
For the widely used FICO scores, that window is typically 30 days, though some older versions might use 14 days. For Vantage Score, it's usually a rolling 14-day window. So practical advice is, try to submit all your formal applications to your chosen top lenders within a concentrated period, ideally within 2 weeks, to take full advantage of this inquiry deduplication. Sparrow gives these general timelines. Good tip. Submit hard applications close together. What happens next?
Once you've chosen a lender and you're formally applying, you'll need to gather and submit all the required documents. NerdWallet lists the common ones: proof of income, like recent pay stubs, maybe W-2s or tax returns; proof of residency, like a utility bill or driver's license; and documentation showing you actually graduated or completed the educational program the loan's paid for, like a diploma or transcript.
Okay, standard loan application stuff.
Pretty standard, yes. And here's a critical tip from both Sparrow and NerdWallet that could save you a major headache and protect your credit during the transition. Keep making payments on your old loans, your federal servicer, your previous private lender, until the refinance process is completely finalized and your existing lenders confirm they have received the payoff funds from your new private lender and your old accounts show a zero balance.
Don't stop paying too soon.
Absolutely. Do not assume the process happens instantly the moment you sign the new loan agreement. There's a processing and disbursement period, maybe a week or two, sometimes longer. If your old loan payment due date falls within that transition window and you haven't paid it because you thought the refinance was done, you could accidentally miss a payment and get hit with late fees and a negative mark on your credit report. Keep paying the old ones until you have absolute confirmation they're paid off.
That is a really, really important piece of practical advice.
It really is. Once the new private loan is officially active and your old loans are confirmed as zeroed out, you'll simply begin making your required monthly payments on time to your new private loan servicer according to the terms you agreed to. And as Sparrow notes, using online comparison tools provided by companies like theirs can also help streamline that initial shopping process by aggregating potential offers in one place based on your profile.
Okay, that covers the how-to. Now let's shift gears slightly and go beyond the decision-making process itself. You mentioned some potential pitfalls and red flags earlier, particularly based on findings from regulatory bodies like the Consumer Financial Protection Bureau, the CFPB. They've done oversight work in this area.
Yes, the CFPB has conducted examinations and issued reports highlighting some concerning practices they've observed in the private student loan market, including refinancing. Their findings are really important for borrowers to be aware of because they point to potential systemic issues that consumers might encounter when dealing with private lenders and servicers.
Okay, what kind of concerning practices did they find?
Well, one significant area of concern they've documented is related to misleading marketing practices by some private lenders offering refinancing.
Misleading how? That sounds pretty alarming.
It is. The CFPB found instances where private lenders deceptively implied, either through their marketing materials online or even during conversations their representatives had with borrowers, that refinancing federal loans with them would not necessarily cause borrowers to lose access to critical federal forgiveness programs like PSLF or teacher loan forgiveness.
Wait, they suggested you could keep federal benefits and get their private loan.
They created a false or misleading impression that borrowers could potentially get the best of both worlds, a lower private rate, and still somehow retain eligibility for federal benefits. This is, of course, categorically untrue, as we've established. Once you refinance federal loans privately, those benefits are gone. The CFPB identified this tactic as a deceptive and abusive practice, basically taking advantage of borrowers' confusion about the complex rules and the significant trade-offs involved.
Wow, that's bad. Actively misleading people about the biggest downside.
It's very concerning. They also found some lenders advertising what the CFPB termed illusory benefits. These were features or protections that were prominently advertised to entice borrowers, but were later difficult or effectively impossible for borrowers to actually access or benefit from when they needed them.
Illusory benefits? Like what? Give me an example.
Okay, examples included lenders improperly denying applications for disability discharges based on criteria that weren't even written into the actual loan contract the borrowers had signed. So the contract said one thing, but the lender's internal policy or practice for approving discharges was different and stricter.
So you think you have a protection based on the contract, but they deny it anyway.
Exactly. Other examples included lenders misrepresenting eligibility for advertised auto pay interest rate discounts. Maybe the requirements were buried in fine print or change, meaning borrowers didn't receive the discount they expected based on the marketing. And perhaps most disturbingly, some lenders heavily advertised unemployment protection programs.
Okay, that sounds useful.
But then the CFPB found that these lenders later unilaterally changed the terms of those programs or eliminated them entirely after borrowers had already taken out the refinance loan, relying on that advertised protection. So borrowers were left without the safety net they thought they had secured when they signed up.
That's incredibly frustrating for borrowers. Being enticed by promised benefits, making a decision based on them, only to have the rug pulled out from under you later on.
Hugely frustrating and potentially financially damaging. The CFPB reports also highlighted issues specifically related to the ongoing servicing of private student loans, meaning how the loans are managed after they're issued.
What kind of servicing problem?
This included things like servicers failing to correctly re-amortize loans after borrowers were approved for some kind of loan modification, like a period of reduced payments. This meant the payment schedule wasn't updated correctly going forward, leading to confusion and potential errors. They also found issues with lenders not allowing borrowers to properly exercise their right to cancel their loan within the mandated 3-day cancellation period after receiving the final loan disclosures. That's a basic consumer protection violation.
Okay. And what about handling disputes or problems?
This was perhaps one of the most concerning findings. The CFPB documented significant problems with how some private servicers handled borrowers' claims related to potential misconduct by the school they attended, situations where the borrower might have a legal defense against repaying the loan because their school engaged in fraud or misrepresentation.
Like the Federal Borrower Defense Program, but for private loans.
Well, the issue is similar, but the process and protections are very different. The CFPB found that some private servicers actively misled borrowers about their contractual rights to even assert these types of claims against the loan holder, the private lender. Even worse, some servicers apparently had internal policies where they would fail to even consider these serious allegations of school fraud at all unless the borrower had gone out and hired a lawyer.
What? So unless you could afford a lawyer, your claim about being defrauded by your school just wouldn't even be looked at by the loan company.
That's what the findings suggested in some cases. It effectively makes a potential contractual right practically inaccessible to borrowers who can't afford or find legal representation, which feels fundamentally unfair. It suggests that even when a borrower might have a legitimate grievance related to the education their loan paid for, getting it addressed by the private loan holder can be incredibly challenging. Unlike the more structured, though still sometimes imperfect and slow, process available for federal loans through the official Borrower Defense to Repayment Program.
That really highlights the value of having those established federal processes, even if they aren't perfect. What about collection tactics?
The CFPC also documented concerning collection tactics used by some private lenders or explicitly allowed by the terms of their contracts. This included things like making false threats of legal action against delinquent borrowers when the lender actually had no intention of suing. Some loan contracts included terms that allowed the school itself, if the school was the lender or closely affiliated, to withhold official academic transcripts from borrowers who were behind on payments.
Withholding transcripts. That could stop someone from getting a job or transferring credits, right?
Absolutely. It's a powerful and controversial collection tool. And in some cases involving private loans held directly by the educational institution, the default remedies listed in the contract even included preventing students from registering for classes, accessing campus facilities, or receiving other essential education services.
Wow. Preventing access to the education itself as a collection tactic for a loan that paid for that education? That's pretty stark.
It is. And finally, payment processing errors were another significant area of concern highlighted by the CFPB findings in the private servicing space.
Like taking out the wrong amount.
Exactly. This included private servicers debiting funds from borrowers' bank accounts early before the authorized payment date. Withdrawing unauthorized amounts sometimes amounts far larger than this scheduled payment. And failing to provide proper advance notice to borrowers when the amount of a recurring automatic payment was changing, which is actually a violation of Regulation E, a federal consumer protection rule governing electronic fund transfers.
So inaccurate billing, taking money they shouldn't have, not giving proper notice.
Yeah.
Lots of potential for errors and headaches there.
Yes, the findings suggest borrowers need to be very vigilant in monitoring their private loan accounts and bank statements.
Now, It's probably worth a brief mention, and I think the CFPB reports touch on this too. The federal loan servicing system isn't exactly perfect either, right? Especially lately.
That's a very important point of context, yes. While the benefits and protections offered by federal loans are a clear differentiator, the day-to-day servicing experience itself hasn't been without its own major challenges, particularly evident during the chaotic return to repayment after the long pandemic payment pause.
What kind of issues we're seeing there?
The CFPB and numerous news reports documented significant problems in the federal system, too. Things like incredibly long call hold times, hours sometimes for borrowers trying to get help or clarification from their federal servicer, widespread reports of inaccurate billing statements being sent out, causing mass confusion, significant delays and even improper denials in processing applications for income-driven repayment plans, which borrowers desperately needed as payments restarted, and failures by servicers to adequately inform borrowers about all their available options, such as the ability in some cases to verbally self-certify their income for IDR instead of providing extensive documentation.
Okay, so it sounds like neither system, federal nor private, is immune from servicing problems, errors, and frustrations for borrowers.
That's a fair assessment based on the reported findings. It really underscores the need for borrowers to be proactive, to keep meticulous records of their loans and payments, communicate clearly with their servicer, and document those communications, and stay informed about their rights and options, no matter who holds their debt, federal government or private company.
You'd be your own best advocate, basically.
You often have to be, yes. It's a complex landscape out there.
Okay, phew. We have covered a lot of ground here. We've defined refinancing versus consolidation, that key difference. We looked at the tantalizing pros, the lower rates, the simplicity, the flexibility, and then the very real, very serious cons, especially for federal loans, losing IDR, forgiveness, forbearance, discharge.
Right.
We explored who refinancing might make sense for, digging into that revealing Reddit example of the high-income earner grappling with the decision. We walked through the step-by-step process of how to shop for and apply for refinancing if you decide it's right. And we highlighted some significant potential pitfalls and concerning practices documented by regulators in the private loan market.
We have. And the sources, taken together, consistently show a clear picture. While refinancing student loans can offer enticing possibilities like saving money through a lower interest rate, simplifying your financial life with a single payment, or adjusting your repayment timeline to pay off debt faster. These potential benefits, particularly when federal loans are involved, come with that significant and permanent price tag.
The price tag being the forfeiture of those critical federal safety nets.
Exactly. Income-driven repayment plans, potential loan forgiveness programs like PSLF, flexible payment postponements during hardship, and certain crucial loan discharge options. Giving those up is the cost of entry into a private refinance loan for your federal debt.
And for those who only have private loans to begin with.
For them, the decision is usually much simpler, much more straightforward. It centers primarily on whether you can genuinely secure a better interest rate or more favorable terms from a new private lender without really losing much in the way of existing benefits, because private loans didn't have those robust federal protections anyway.
But for federal loans, it is unequivocally a deeply personal and highly complex calculation.
Absolutely. It requires you to honestly, brutally honestly, assess your current financial health, your realistic job security, your likely future earning potential, your personal tolerance for risk, and the actual likelihood, however small you think it is, of ever needing those federal safety nets down the line.
The key lesson distilled from all these sources, the absolute core takeaway for listeners today, seems to be that there just isn't one universal right answer that applies to everyone when it comes to refinancing federal student loans.
There really isn't. The potential monetary savings on interest offered by a lower private rate must be realistically and very carefully weighed against the intangible but potentially crucial value and necessity of the federal protections you would irrevocably permanently give up. The right decision depends entirely on your specific circumstances, your priorities, your future plans, and your comfort level with taking on the additional risk that comes with private debt.
So, use the insights we've discussed today about understanding the qualification criteria, the absolute importance of comparing multiple offers using soft checks first, really scrutinizing the terms and fine print of any private offer, and being fully aware of the potential pitfalls and regulatory issues we highlighted. I'd use all of that to make a truly informed choice that's best for your student loan journey and your overall financial well-being.
Indeed. It's really about looking beyond just the headline interest rate number and understanding the full picture, everything you stand to gain, but just as critically, everything you stand to lose.
So here's something to leave you with, a final thought to maybe mull over as you consider your own situation. Considering the inherent complexities of student loan debt that we've talked about, considering the potential pitfalls and the documented servicing issues that regulators have found affecting both the federal and private systems,
Hmm.
and considering the simple fact that life rarely goes exactly according to plan, does simply chasing the absolute lowest possible interest rate always represent the truly best, most secure, long-term financial decision for managing this significant debt? Or could it be that the stability, the flexibility, and the robust safety net offered by retaining those federal protections, even if it means paying slightly more in interest in a best-case scenario, is actually worth more for many borrowers in terms of long-term peace of mind and overall financial resilience against life's uncertainties?
It's a lot to think about, and the answer, as we've said, is going to be unique to you and your circumstances.
Thank you so much for joining us for this deep dive into the complexities of student loan refinancing. We really hope this has provided you with the insights and the framework you need to navigate this important financial decision.
Indeed, it was a great discussion. Until next time, keep digging into the details, key into asking the important questions, and find the path that's truly right for your financial journey.